The superannuation industry is riddled with fine print, complexity, smoke and mirrors. It might surprise you to understand how the majority of superannuation funds in Australia are actually investing your money. Let me explain. Most use what I refer to as the pie model. They're a diversified managed fund. And they work like this. For every dollar that you put into this pot, that dollar is spread across a number of slices of pie. We have some cash, some fixed interest, they'll give you some property, some Australian shares and some international shares. Then they pigeonhole you into what's known as a risk profile, meaning the younger you are, the more shares you're given, the older you are, the less shares you're given. And they call that high growth, balanced, conservative. Let's assume that you're a growth investor. That might mean you'd have around 40% Australian shares. We might have 30 in international. We might have 10% cash, 10 bonds, fixed interest, and 10% property. For every dollar that goes into this pot, 40 cents is going to be invested into Australian shares. Now, my argument with this model is, who's to say that I want 40 cents going into Australian shares this month, or next month, or the month after that? That discussion does and will change constantly. The second thing is, every investment gives you two types of returns. We get capital, which is the value going up. Two is the income that the investment generates. That income is reinvested in this model back in to the slice of pie that generated that return in the first place. And my argument's still the same. Who's to say that I want to reinvest my money back into Australian shares this month? We might want to redirect that towards bonds or cash or property or another asset class that we think represents better value given what's going on in the world at that time. The biggest kicker is that a managed fund such as this has a mandate on how they can invest money for you. That mandate is laid out in what fund managers call their product disclosure statement, or their PDS for short. And it says that this is a growth fund and the allocation is 30, 40, 10, 10, 10, because that's what you've told them to do because you picked a growth fund. Okay? So they can only invest a few percent either side of this line until they get outside of their mandate, which means they've got to rebalance the portfolio back to the 40, 30, 10, 10, 10. In other words, if 40 turns into 45, turns into 50 because markets are performing really well, they're going to pull you back by default. On the flip side, if 40 turns into 30 because markets are underperforming, then they're going to reload you by default as well. It's what the industry refers to as strategic asset allocation. Spread your eggs and then just let the markets do its thing over time. Okay, now I'm not arguing that time is not an important factor when you are investing. It is. My argument always is, if time is your only real means of managing investment risk, what are you paying for? I do find this model a lazy, outdated and passive way to build your hard-earned money. What we advocate is what's referred to as a dynamic asset allocation strategy. Asset allocation is going to be the key driver to your return. Funny enough, stock selection comes second, but we need to be in the right market at the right time if we've got any chance to make good coin in the future. So rather than pigeonholing your money at 40% this month, next month, month after that, have a tactical range, 0 to 60 in the shares. Then you can dial down, dial up exposure at any time given what's happening in the marketplace. It's far more proactive, appropriate way to manage your money this day and age. To find out more, tailoredwealth.com.au.